Founders have to raise money all the time. This is my 7th or 8th time raising money, and it's quite an opaque process if you've never gone through it.
The Business of Betting podcast is presented by Optimove, the #1 CRM marketing solution for the iGaming industry. 4 out of the top 5 U.S. operators personalize player experiences with Optimove, the #1 CRM marketing solution for the iGaming industry. Learn more about Optimove by requesting a demo at optimove.com/businessofbetting. And if you like what you see, you will get your first month free.
What is up, everybody? I am Jason Trost, the host of the Business of Betting podcast. I am joined with my Canadian best friend, Jesse, the host of the Betting Startup podcast. Welcome to the podcast, Jesse.
Thank you for having me, Jason. No tariffs here, I hope, for being on the pod.
Well, it's nice to see that Americans and Canadians can still be civil with one another under these trying times between our two countries. So thank you for being civil and not taking advantage of our free defense that we offer you guys.
Hey, just happy to be here. Wild times right now, isn't it?
Wild times. Before we get to that, I want to set up today's pod. So one of my reasons for being a podcast host in this space, and one of my reasons for the company I started, in fact, is I like the idea of making things fair, more transparent, shining a light on things. So the mission of Smarkets is to basically bring better pricing and more fairness to sports bettors. And one of the things that I'm passionate about on this podcast is trying to pull the curtain back on the industry, what's going on. And I am in the process of trying to raise a Series C financing round. And Jesse thought that would be an interesting topic. Founders have to raise money all the time. This is my 7th or 8th time raising money. And it's quite an opaque process if you've never gone through it. And Jesse thought it'd be a good subject. So Jesse's going to ask me questions and we're going to talk about my fundraising round and get into it. But before that, Mark Carney, I want to say I love Mark Carney. Sorry to talk about politics, but it's my passion project. I was very impressed with him when Brexit happened. He was just such a steady hand in the whole Brexit process. And I know he's not American, but I loved hearing that North American accent from a guy who was running the Bank of England. It was but not only was it fun to see a North American running the Bank of England, but he was so level-headed, and you could tell he has quite a bright head on his shoulders. And I'm very impressed with this guy as an individual. I want him to be my president, to be honest with you. And so good on you guys. I don't know if it feels like oftentimes people are perceived differently from the outside. Like, I love Macron, but a lot of the French hate Macron. I think Macron's a good external president, but maybe a bad internal president. What's your take on Mark Carney?
So I think we're all trying to figure that out right now. I mean, to your point, he's been, a central banker for many years and comes from a finance background, governor of the Bank of England, also governor of the Bank of Canada. So he has that pedigree. Absolutely. He's not a politician by trade, which I think in these times feels like a net positive. His opponent in the recent federal election last week here in Canada, PP is his acronym, I can't even say it, Pierre Poilievre. He is a career politician, right? He literally has been in parliament for 20 plus years, and Mark Carney is like the exact opposite, never really had a political role in his life. So I think there's a lot to be said for that. Obviously, with no background in politics, nobody really quite knows what to expect from him. And it's like second week on the job right now. So it's very much just kind of like, we're sort of seeing who we have now. And, so far sentiment seems to be very positive. And obviously, with the backdrop and the elephant in the room being this strained relationship with the US, I think Canada and the people here predominantly are looking for a quote unquote adult in the room to really try and steer these conversations, because it's pretty high stakes stuff, right? And, even the tariffs that have been implemented so far, or even the threat of tariffs before they even came in, has had like pretty dramatic impacts on the Canadian economy. Companies can't really plan accordingly with the threat of looming tariffs. So they're like cutting budgets proactively, laying off proactively. And very quickly here in a short couple of months, like the downstream impact of that on the economy is then like pretty acute. And you definitely feel that energy here on the ground right now. So looking for somebody to come in and like really try and not be bullied. Obviously, that's sort of everybody's goal right now with the current political environment. And, hopefully Carney's the man to do that.
Well, I mean, it seems like it, at least from the outside, at least from what I know about him. I listened to an interview he did with Scott Galloway, and he just comes across as credible and sharp and smart. In America, we fight about these sort of like issues over and over again, like whether it's illegal immigration or abortion. What are like the top issues in Canada where this PP guy and Mark Carney, what are like the one or two issues they disagreed about?
There's a lot of contentious issues in Canada, as there are in other countries right now. Taking sort of the US-Canadian dynamic out of the equation for a minute here, because obviously that's like been thrust into the forefront. Putting that aside, some of the hot button issues are related to, immigration and sort of the sheer numbers that we've seen over the last few years here and the impact of that on our infrastructure. Again, much like a lot of other countries right now, from a housing perspective, real estate's insane here right now. It is not sustainable. The average person can't afford to buy a home. So that's a hot button issue for the middle class. And adjacent to that is our healthcare system, right? We do have, what's often perceived as being this amazing system of free healthcare. Everybody gets access to it, which is true, but it is under severe strain right now. So while, yes, the healthcare is free, it is not nearly as accessible as one might think. So there's a lot of tension over that.
Just to give me an example, can you pick one of those issues and say like the PP position and the Mark Carney position? And because I think most Canadians would agree there's a housing issue, there's an immigration issue. Those don't sound contentious. Are the solutions contentious?
I would say the solutions generally are contentious. Mark Carney came out on the housing side of things, almost like a wartime era type message where he's like, the government will get involved and rapidly build 500,000 new units per year and like really try and like catch the supply up to the demand. And the contention, I would say, is like not so much the opposing party's position on it, more so like their lack of position on it. Like the Conservatives who lost the election, they put out their platform like a week before the election. So there was a lot of like just like politicking through the campaign process. There wasn't actually a lot of like talk about the solutions to these very acute problems, which I think was really one of the downfalls of the Conservatives. And if you rewind the tape, like whatever, like even 3 or 4 months ago, when Trudeau announced he was stepping down, the Liberal Party, which Trudeau is a leader of and has been in government for 10 years here in Canada, their numbers were basically at like historical lows under Trudeau after 10 years. And basically it was like a layup that PP would win the election, right? His polling numbers were through the roof. I think there was like a 20 or 25 point sort of gap in the polling numbers at that time. That was like 3-4 months ago, which feels like a long time ago now. And Carney, Carney, enter all of this tariff stuff. And very quickly, sentiment here changed from we need change and we need the Liberal Party out to we need an adult in the room here that has some of that pedigree and experience to really like deal with this new issue head on. And Carney somehow reversed fortunes for the Liberal Party. And I think the historians will look back on this period and the Conservatives sort of fumbling their opportunity as an all-time political fumble. The PP campaign was very much sort of out of the Trump playbook in many ways, right? A lot of rhetoric, a lot of like appealing to what they call maple MAGA up here, and really trying to take that approach. And that turned off a lot of people once this sort of threat of tariffs entered, and people, as kind of over Trudeau as we all felt, we weren't really at that point, I think, willing to sign up for this sort of divisive political, focusing on all these social issues. We were kind of over that. So yeah, anyway, it worked out well for Carney. Obviously now like pressure's on him and it's his moment to demonstrate to everybody that he is the man to face this head on. And obviously we're all rooting for him, but it's a job that I don't think many people would want. And, hopefully he does well for us.
It's interesting you said the Conservatives didn't really have a position on building housing because the Republicans are often like that. They're sort of the party of no. I've learned about that at work where it's really easy to criticize something. It's really hard to work on the solution. And the Republicans, for as long as I've really known them, or at least relatively recently, for sure, have been the party of criticizing the Democrats for this, that, and the other, but they don't have an alternative. Like Trump still doesn't have an alternative for what healthcare should look like. I would say the only thing they're clear on is illegal immigration, which they kind of took the ban hammer, the anti-constitutional hammer to that one. At least they're clear on that. But even with the tariffs, sometimes the tariffs to raise money and get rid of taxes. Sometimes it's to make things fair. Sometimes it's to help blue collar America. Sometimes it's to reshore critical industries. They don't have a clear message on any of this stuff. It's just kind of like the whims of a madman just deciding to do these crazy actions. But this whole like balanced budget thing, the Republicans talk about balanced budget, which is kind of their jam, but they don't have any concrete ideas on how to do this. Doge was supposed to magically save $1 trillion, which I think it's saved $50 billion of the last count, which is, not $1 trillion. And, it looks like the Trump administration is going to spend more than the Biden administration does. So not only are they not cutting, they're going to increase spending. So anyway, it's a farce. Good luck to Canada. I'm rooting for you guys. And it's nice to see Mark from afar. I'm an admirer of his and he seems like a very capable leader. So I think you guys are in good hands. All right, let's pivot to sports betting. So fundraising, how do you want to start?
So let's just unpack some language and some definitions, because I don't want to assume everybody in the audience is even familiar with what fundraising means when you have a company. And even at the opening here, you mentioned like a Series C round you're doing. I know what that means, but not everybody knows what that means. Like, let's just start with some maybe just some general principles on why a company fundraises, what that means. When you go to talk to investors, what does that look like? Give us and you've done a few rounds of this, so you have some reps under your belt, but give some high level context to start. Just what does it mean for a company to go out there and raise money from investors? Let's just start there, then we'll drill down the few specific questions I have.
I can speak to America and the UK and contrast them a little bit, but in the UK and in the US, there's this notion of a company of shares. In the UK, they call it a limited company. In the United States, they call it a C Corp or an S Corp. And it's basically a fancy way to say that there are shares that belong to this company. Each share has a fractional ownership of the overall company. And the share price times the number of shares is the implied value of the company. There's a bunch of reasons people do this. The main reason is for liability shielding. So if the company goes bankrupt, the people who are running the company are not personally liable and the company's liable. There's other benefits to it, whether it's organization, ease of selling or whatever. So that's the main structure of a company. There's other structures like partnerships and LLCs, which I'm less familiar with. There's pass-through companies. I'm less familiar with those. But in most startups that you will have heard of are for-profit share-based companies, and that's their legal basis. Now, in order to raise money, there are two things that you can do to raise money typically. You can do debt financing, which is basically you go get a loan. That's like a mortgage for the company. Instead of buying a house, you use it for operations of the company. Just like a mortgage, you have terms of that debt where you have to pay it back by a certain date with a certain interest rate. And if you don't pay it back, usually the people that lent the money get the company, just like the bank gets a house in the American example. If you don't pay back your mortgage, the bank can repossess your house. The more common way, at least for tech startups, is to do what's called equity financing. Equity is a fancy word to mean share-based financing. And let's say in a simple example, your company starts with 100 shares. Equity-based financing is you make new shares. So the company issues new shares. The incoming investors buy those new shares. And then let's say you have 100 shares and investors want to buy 30 more shares. They give you whatever, $100 for the 30 shares. Then the company will be 130 shares and be worth $100 more than it was before that investment. That's the basis of most financing. So when people say Series A, B, and C, what that refers to is there are these special rights that can come, don't have to come, with shares called preferred rights. And Series A means the first time you do a preferred offering. Series B is the second time, and Series C is the third time. And they may or may not have different rights from other preferred shareholders. And they will certainly have different rights from common or ordinary shareholders.
That was a really crisp overview. Well done.
Was that too wonky? It felt a little wonky.
No, you got it. I was talking to ChatGPT here.
Okay. With nice little emoticons with my bullet point.
So with Smarkets, then you mentioned this is your, implied in that the fact you're going for a Series C now, therein is implied, this is your fifth, sixth time, I guess, going back to the well for additional capital to fund the next stage of Smarkets growth. Obviously, for any company, when they're first getting going, you often hear terms like, pre-seed or seed or angel, which typically investors you would go to that are not institutional investors. These are typically people that are high net worth individuals. Oftentimes with your friends and family that put in the first 5 or 10K into a company. So at the early stage, you're typically dealing with individuals. As a company grows and gets to the next stage of its evolution, you need potentially to raise more capital. The capital amounts can be much greater than the early stage. And at that point, you are often talking to institutional investors, right? Venture capitalists, VCs, a term a lot of people I'm sure will be familiar with. These are groups that invest professionally, right? It's literally their job to deploy capital into promising businesses. And I want to, I guess, maybe just before we get into the current fundraise for Smarkets, kind of go back to your experience at the early stage of Smarkets, raising the initial capital to kind of go from 0 to 1 as a business. And since then, obviously, you've brought in additional capital partners, which are institutional backers. And I kind of want to get your perspective on raising money from individuals and the angel investors, if you will, versus institutional investors. What is sort of structurally different about talking to those two types of groups of capital allocators?
Great. While we're on the lexicon, I think it's important to note whether it's angel funding, seed, pre-seed, series A, B, C, whatever, those are all conventions. Like there's not a legal definition of what seed financing is or angel financing or series A. They're conventions, they're shorthand for people who are in the business to know what stage you're at. And there's rough terms and rough amounts that go with each of those stages. Those change based on industry and trends and things like that. But when you say a Series C business, that's usually a growth stage business. Check size is 10 to 50 million. Well, it depends. I mean, AI can be, 500 million or something like that. But usually done 4 or 5 financing rounds, you're fairly mature. Whereas pre-seed means you may or may not have a prototype. It's small checks. It could be anywhere from 10K to 500K. So each of these have conventions and different sizes. In terms of how I got started, I think I read a few books. One of the books that kind of stuck with me was a book by Guy Kawasaki called The Art of the Start, which I found very helpful. But
Not the art of the deal?
I missed that one. I'm sure it's on your bookshelf. The Art of the Start basically says get going, and he's got ideas for or suggestions on how to make a deck and how to pitch and all that kind of stuff, which I found very helpful. But basically, the short answer is a volume game in the beginning. So back in the day, when I first started raising money, is 2008, we had a business plan. I wrote like a 30-page business plan, and we didn't have a demo. Nowadays it's hard to raise without a demo, but back then you could raise without a demo. And I basically made a list of all the people the richest people I knew, but rich with a low bar, people that could write. I tried to think about anybody I'd ever run across, whether it was college, high school, people that I worked with, people, my neighbors, all that kind of stuff, who could write a 25K check. And my goal is to raise $200,000 or 200,000 pounds. And I think I pinged 200 people and I got 5 yeses. So my first round, I think I ended up raising around $150,000. Ran out of money. When you're 26 and you're starting a business, you think $150,000, that's shitloads of money. Like I'm never going to need to raise again, but I needed to raise again like another year. I did that again. So I did 2 rounds of friends and family, small check sizes. I think the check sizes were $25K to like $75,000. And I have lots of crazy anecdotes. There's one guy I used to work with at UBS, and I thought I was going to invest. We were close and he liked the thing. And we probably talked like 5, 6, 7 times. And eventually he wavered and said, no, it's not for me, and passed, which is absolutely fine. And then I got one of my colleagues to invest. And I think I talked to him for probably like 20, 30 minutes. I'm like, I'm trying to do this. He's like, cool. Sends me an email and said, hey, my boss wants to invest. Can he invest? And I was like, yeah, sure. And I was like, it's a minimum of 25K. And he's like, my boss is in for 75K. And it was like the most money I'd ever seen. It was like the least amount of effort. So it was quite a lesson. Like the guy that I spent probably like 5 hours on was a no. And then with another guy, I got 75K. And I don't think I'd even talked to him. It was like 3 sentences on an email. So it really runs the range of low effort, low time, high time. And there's not a rhyme or reason. It's people are people, and some go fast, some go slow. Sometimes it's timing, sometimes it's luck, sometimes it's your persuasion. So it's really, really, unless you have a track record, it's a numbers game in the beginning.
Yeah, I often hear at the earliest possible stage, right? Yeah, you can write a business plan, but like business plans typically aren't worth the paper they're written on, right? As you know, like things change so quickly, the best laid plans always change, right? So business plans typically aren't great. Obviously, as an investor, investing in somebody at a very early stage, you want to have some sense of like their understanding of the market and the opportunity and their credentials to pursue that opportunity. But really, like the old anecdote goes, at that stage, you're betting on the jockey, not the horse, right? You're really betting on the founder and the individual and their ability to adapt what they're up to and adapt that plan to what the market's telling them as they're getting out there with this new thing that they're putting out there. So it is interesting, like at the early stage, I think they very much are betting on the person or the individual more so than the plan itself. Obviously, plans are important. You want to have an understanding, but I do think that shifts and evolves over time. And I would reasonably assume probably where you're at now at the much later stage of the financing cycle, it very much is more predicated on like hardcore business metrics and KPIs and things like that, as opposed to, betting on Jason Frost, the founder.
One of my favorite YouTube guys is this professor out of NYU, and I hope I'm pronouncing his name correctly, Aswath Damodaran. He's this professor of valuation at NYU. He's got these great videos and podcasts, which I highly recommend anybody checks out. But the way he describes valuation, it's a mix of storytelling and numbers. So you have to have the numbers for the factual basis, and you have to have the story to kind of show where the business is going. And I would say that's true at all stages of the business. Probably as you get older, it skews a little bit more towards numbers because you have a track record and a cost of acquisition and a funnel. these kinds of things. But I think, even if you look at somebody like Elon Musk is like a magician of the storytelling aspect. He's very weak on the numbers side. Like you can just look at the price of the Tesla stock to see that. Like Tesla should be valued at like $18 a share if you were to value it the same way you'd value Ford. That's a great example of where the shareholders have given it like 98% credit for its story, where, another company, I don't know if there's an example, but maybe a utility company. So if you take just some random utility company, oftentimes they're just based on the numbers and there's no story. It's like we just generate power and sell power, and as more people move in, we sell more power. So it's less of a numbers story. Ford might be a good example. I think Ford has quite a low PE ratio. So that's more of a clear, like numbers driven story, where Tesla is a story driven valuation. So that's true at any stage, from the earliest to the end. Now, when you're just starting the company, you're not going to have that number. So you better have a good story. Otherwise, you're not going to get very far. But I think you need both at all stages of the process.
Okay. So you started Smarkets, you got the early stage financing out of the way. Obviously, you launched, you got a business going. And then at some point you had additional capital needs. So you went back out there, raised more money, though this time you probably weren't making a list of former colleagues and their bosses to ask for 25K checks. You probably had, more significant capital needs. And therefore, the people you go talk to about that are a bunch of different people. So talk about, I guess, the shift going from talking to high net worth individuals to talking to institutional investors. What are institutional investors looking for? Like, how are those conversations different based on your experience having raised money?
Well, I'd say there's an intermediate step. So the first round is usually called friends and family. Sometimes it's jokingly called the 3 Fs, friends, families, and fools. But usually it's friends and families. So you go find the people that know you, and you're banking on your personal reputation to raise the money. Then it's angel financing. So angels tend to be like not necessarily institutions, usually not institutions. They're either rich people that like to invest in startups, or they're usually oftentimes they're former founders that want to cycle some of their money back into the ecosystem. So that's what we did next. We started talking with angel investors. When I was in London, after I did the friends and family, I didn't have a network in London. I went to like every event that I could, and I met every VC that I could. I'm pretty sure I met the whole ecosystem. At the time in 2008, 9, 10, the London ecosystem was a lot smaller, so it was much easier to meet everybody. But I went to every event, talked to every VC, pitched every VC. There was something called Open Table, I'm going to say, organized by Saul Klein, and he had an event, I want to say once a month, every Thursday. That was kind of a way to meet a lot of people that, to be honest, I still keep in touch with some of those people that I met back then. So I basically took every opportunity to go to every networking event that I could. And along the way, I got no's from pretty much everybody, similar to raising money with friends and family. But this time, when you get yeses, the check size is bigger. So angels will be like 100K. Well, friends and family might be like 5K to 50K. Angels might be 20K to 200K. And pre-seed financing from an institution might be like in that 500K, just to put some raw numbers on it. And the first one from the ecosystem that I ended up raising money from was a guy by the name of Stefan Glenzer. He was one of the co-founders of Last.fm, and he got me plugged into the ecosystem, the sort of the more institutional ecosystem. But he was my gateway from friends and family to a more professional investor set.
I forgot about Last.fm.
I think it was bought by CBS for like 22 million. It was one of London's early successful startups, and it's in the distant past now. But at the time, it was like a huge win for London. Like the founders were angel investors, and we ended up the first Last.fm employee became one of our first employees. So it's one of the first success stories. It was like them, lastminute.com. It was like moo.com. Were a few of the successful startups in London. There weren't very many in the early days.
All right. So institutional capital now, you're out there talking to venture capitalists, which is a much different ball of wax than friends of family or angel investors, as you just described them. What's it like going into meetings with professional investors, right? Because you go into a room, you go into this, first of all, you back up, you go into this office, you're at the front desk, they welcome you in. Right away, you're feeling like intimidated, right? There's a lot of power dynamics in there. Obviously, when you're out there asking for money, almost by definition, you don't have the leverage. The capital has the leverage, right? So you're already in a position of like weakness going into a meeting. You're sitting around in the waiting room. You're probably behind schedule. You get pulled into the boardroom. Palms are probably sweaty. You get in there. You got like 5 minutes to make your pitch and compel this guy. Like pull the curtain back a little bit on like what's it like actually going into these rooms to pitch these guys who are like professional money men and women.
You're setting the scene pretty well, actually. That's a pretty good introduction. So yeah, they're usually in these big board meeting rooms, which like maybe after COVID, it's more online, but it really depends. But I would say at least in London, there was a type of VC, and I think it's becoming a little bit less common, but there are typically bankers that became VC investors. Whereas I think in the States, it's usually more founders that become investors. So most of the VCs, if not almost all of the VCs I met, were not founders themselves, which I personally found very frustrating because it was hard to speak a similar language. But I mean, some investors would give me a hard time, but maybe one of the misconceptions from the outside, it's not a combative kind of thing. And it's rarely a formal pitch where you stand up and you have a slideshow and you click through the slideshow and you do it, ask for questions. It's usually more you start with a coffee, you do introductions on each side, and you start to have a chat. There's just like any area of finance or any kind of thing of business, there's people who are assholes and arrogant and kind of high ego. And then there's people who are super helpful, nice and low ego and willing to help. So it's really just like anything. There's some people that are really pleasant to deal with and some people that are assholes, to be honest with you. And I've had I would say by and large, almost most of the VCs I've dealt with are nice people. I've had a few cases of assholes where I walked out of that meeting, I said, fuck that guy. But by and large, most VCs they want to be helpful. They want to they're not there to like call you out and give you a hard time. They're there to see if you guys can partner together. Most have a positive spirit when they're meeting with you.
Well, and a lot of them trade on their reputation as well, right? I mean, they're building brands in their own right. So, if you're an asshole in any line of work.
I would say that's more true in the States. In my era, there was very few startups, but there's also very few VCs. So if you wanted to do a startup, you had to go through like 8 VCs. And so it was more of a VC market, if you like. I think in Silicon Valley, it became kind of a founder market because there's such a power law with like the top startups that in the States, all the top VCs compete for the top startups. So the reputation matters a lot more. I think that dynamic played out a lot. I think it was a little bit the reverse in Europe because there were so few VCs and there was more founders for the VCs. So the VCs were in the driver's seat more than they were in the Valley. I think ultimately to the detriment of the ecosystem here. I think it's no question the Silicon Valley / American, I don't know what it's like in Canada. The Silicon Valley American ecosystem is just like crushes the London ecosystem for various reasons. But yeah, generally VCs are nice. They ask questions. They try to understand what you're trying to do. And most times they say, thanks, but no thanks. And you move on to the next one.
All right, so let's fast forward now. Smarkets, you're out there. Smarkets is raising additional capital. I don't have a lot of insight into your business other than what you share on the pod. I do think you've mentioned on the pod that now Smarkets is operating profitably, it's self-sufficient. So why, as a profitable business, do you or does any company go out there to raise additional capital? What's the thesis there? What's the driver? Why would a profitable business go try and raise more money?
The main reason is just like, why would an unprofitable business want to go raise money is because you're trying to do something that requires cash that you think will ultimately benefit shareholders. That's everything in business comes down to for the benefit of shareholders. So in a profitable business, you might want to make an acquisition. You might want to launch a new jurisdiction. You might want to launch a new product line. You might want to give a promotion to customers. There's lots of different reasons that require cash. And even if you're profitable, so to put numbers on it, we did $31 million revenue last year and $6 million profit. So it sounds nice. It's a nice business. We're very proud of those numbers. But with $6 million cash, even though that is not a small amount of money, it's also not a large amount of money. Just to put things in context, I'm not sure if it's combined or both, but I think between FanDuel and DraftKings, they spend $1 billion a year on marketing in the United States to acquire customers. So $6 million, $1 billion, $6 million, $1 billion. So oftentimes the bigger your ambition, the more capital that's required, whether it's regulatory, whether it's headcount, whether it's marketing. And those are usually the two reasons you want to raise money. Oversimplified is marketing spend or headcount. People are incredibly expensive. So one of the things that, from the outside, you might not appreciate this, but so not only do you have people's salary, but you have the overhead of employees have incredible overheads. So you usually have a pension that the company has to contribute to. There's payroll taxes. In the UK, it's about 13% payroll taxes. Pension is, I think in the UK, you have to do some kind of match. Healthcare costs, bonus costs, sick pay, and all these in office space, of course. So offices are God, I don't know, I'm rounding up, but like say $500 per employee per desk. You round up all these things, people are incredibly expensive. So anytime you see a company, you can kind of estimate how much their people overhead are expenses by guessing what everybody makes, adding an overhead and multiplying times the number of employees, and it adds up very quickly. So people and marketing are the two big reasons to raise money. In our case, what we're trying to do, we have two products. We have a B2C product called SBK, which is a retail sportsbook, and we have a B2C product called Smarkets, which is kind of a high-end betting exchange. Our vision is to keep building out SBK, but we want to launch in new jurisdictions, namely additional American states. So we need money for licensing. So we need money for market access. We have to go pay casinos, which I've talked a lot about on the pod, which I think is bullshit. But we have to go find local partners to pay them for the right to operate in that country. We have to pay the state regulator and associated auditors to get licensed in that state. And then we have to pay for marketing. So I want money for that whole process. And then on the Smarkets side, we're playing with this idea of adding additional financial asset classes to the platform. That requires additional products. So that's headcount. And that will require additional regulation, which is headcount. And so we want to raise money for that as well.
Are you able to say how much you're raising?
I'm trying to raise $50 to $60 million. Just to put things in context, I'm in year 17. I think I've done 5 or 6 rounds of financing. I've raised $35 million in total. The last round was the Series B for $30 million in May of 2021. That $5 million, I think, was spread out. Like, it might have been like 5 or 6 rounds. It was like lots of small rounds. But I've also had failed financing. So I've used bankers. I've done it myself. And so pretty much from, I want to say 2008 to 2018, for 10 years, I was constantly fundraising for 10 years. And I did, probably around like every other year. But the years I didn't raise a round, it wasn't because I wasn't trying to, it's because it wasn't successful. So this round may or may not be successful, and we may or may not raise the money. The nice thing is, if you follow Paul Graham, we're default a live company, meaning we have we don't need the cash. So we're in a great position. Most startups are not as lucky as we are to be in a profitable position I'm trying to raise 50, 60. We'll see if I get it. We may not get it. And lots of the fundraising rounds that I have done in the past have ended in failure. In 2018, I signed a term sheet with a very well-known private equity company out of New York. Lovely guys. Still talk to them to this day, and no hard feelings about it. But the deal fell apart in the 11th hour. I think it was for like $20 million or something like that. And, we did 6 months of work, due diligence, lawyers, all that kind of stuff. And at the last minute, they said, we're not feeling it. And I said, okay. And that ended, and we didn't raise money. That was in 2018. And we raised money again in 2021. So these things come in waves, and you don't know when they're going to close.
2021 was the golden era for fundraising, wasn't it?
It was, yeah. You don't know it when you're in it, but with hindsight, yes, it was.
All right. So you're out there trying to raise $50 to $60 million. Sounds like part of the story now, coming back to the storytelling aspect of it, right? Obviously, you have, like the pure business metrics to support the ask, and, the business model is fairly fleshed out at this point, but there's that narrative component on top of it that you talked about. Part of the narrative, it sounds like, is growth in the US market. So let's talk about that for a minute. You have, I think, in an Office Hours episode a few weeks ago, you very subtly alluded to the fact that you're looking closely at the CFTC model and sort of this prediction market ecosystem that's emerging in the US. If anything, can you share about how aggressively you're looking at that, and how that $50 to $60 million, if you secure the bag, might play into that model?
Well, whether or not we raise the money, we're definitely going to get a CFTC license. It fits with the vision. It fits what we've been trying to do for years. And hats off to Kalshi for proving the model and blazing a path for it to work. But we definitely want to compete in that space. And we've started an application process for the CFTC. The flip side is it's an incredibly slow process. So I'm anticipating it not to be a very fast application process, but we definitely want to do that. As for other asset classes, we don't know the order, but ideally at the end of this process, we want to do all asset classes so that no matter what you want to trade, you can trade them with Smarkets, and you don't have to have 10. Right now, I have like 10 different apps. You want crypto, you trade this. You want stocks, you trade this. You want your 401k, you trade that. You want sports, you do this. You want an exchange, you use that. You want this bank does this. And I don't think you have to be a genius to see it's so annoying to have all these places with all these different, your money's scattered everywhere. And I think it would be nice, amazing even, to have an app that does all your money needs in one place. And I want to be part of that future.
That's a big idea, having these multiple asset classes. How does that work though in practice? Because obviously with Smarkets, right, you've put in all of this work over 17 years to build the function to create this asset class, right? The market making side of it and all this complexity with that, smart people you need to bring in that are expensive, like you talked about. I would assume some of these other asset classes have that same level of complexity. Like these are very like hardcore things. Are you thinking about trying to build them from the ground up, or are you thinking about a strategy to partner with a company and you would basically be a reseller or a distributor of that asset class through this Smarkets platform?
Both. We're working through that right now, but I think there's a world where we become a broker similar to Fidelity, if you like, where Fidelity doesn't actually own the exchange. The customer layer sitting on top of the exchange. I think a lot of traditional finance works through the broker model, which works very well. And I think in some cases in the CFTC model, we definitely will want to have our own exchange because we think we have an edge in that market. I think there's some interesting aspects of crypto, potentially building our own exchange. I think we can offer some interesting innovations in the marketplace, but I think it's both a broker model and a build it model. And we'll have to see how that plays out over time.
For sure. So, okay, you're raising a Series C round. You talked about the progression going from, the first $5,000 check from Uncle Tom or whatever to, $50 to $60 million at the Series C. Where does the path lead for Smarkets, like as you see it right now? Obviously, you don't have a crystal ball in front of you, but like, where does this all lead, right? Is there a Series D, E, F after this? Is there an IPO? Like, I guess, how are you thinking about where you go after a Series C?
Well, to basically summarize it, there's two ends of a company, or I guess three ends. You either go bankrupt. Let's leave aside bankruptcy. Two positive ends. You either get bought by a bigger fish or you list. Those are the two outcomes. My personal ambition is to list on a stock exchange, be a publicly traded company, but the most likely outcome of all companies is to be acquired by a bigger company. I don't want to go down that path right now, but that is also, those are the two viable paths, basically. In the UK, Deliveroo just got by DoorDash, big American delivery company. So even publicly traded companies can still be acquired by other companies. Sometimes there's these things called take privates, but the two basic exits are acquisition and listing of the shares on a publicly traded market.
And you said you were 17 years into this Smarkets journey, which is, a crazy amount of stamina for any one person to have, like taking this thing from inception to where you're at now. And it sounds like with what you just described, with the ambition you have, like no signs of slowing down. You're in like still in build mode potentially. How do you sort of think about like your stamina, I guess, as founder, as CEO, and kind of you're basically like starting a new chapter of Smarkets if you secure the bag with this round. Like, what's the mindset, I guess, there for somebody that's been grinding for so long at this one thing?
That could be a podcast in its own, I think. But I think it's a lot of things. But if I were to slim it down to a few points, I would say, am I still learning? Am I still excited about the challenge? Do I still think I can make a dent in the universe? And right now, all those three things are yes. Like in sports betting, my mission, as listeners of this know, is I want to disrupt the pricing model of sports betting globally. I think that's worthy. It's a worthy cause. I think it needs to be done. And besides Smarkets, I don't see any other company working towards that. So that really motivates me. This idea that I think betting is globally unfair and takes advantage of people and fuck that. That's exciting. The idea that I get to choose who I work with is very exciting. I'm in a very privileged position where I'm at the head of a company and I have the latitude to work with whom I want, when I want, where I want, all those kinds of things. So I got personal freedom to do those things. And then I think I'm a tech geek at heart. And there's so many things that I would love to innovate on in different asset classes, trading, AI, all these kinds of things. And Smarkets is still a vehicle where I get to play with those ideas. I just started a mini R&D team internally that we're working on a special project, and hopefully it'll see the light of day. But it's kind of a way for me to dip my toe back into the 0 to 1 bucket of trying to launch a new product. In terms of long-term stamina, I have an amazing wife. She really helps me. I exercise almost every day. I have a coach. I have a therapist. I'm in a group called YPO where we do kind of a group meeting once a month in a confidential setting where you kind of talk about your personal and business issues in a confidential forum with other CEOs. So I do all these things to kind of help me stay in the game. I would say as I'm getting older, good sleep and exercise is the basis for everything. When I was young, I was never a natural athlete, but I was always naturally in shape. I always had lots of energy and I could play. I was never very good at sports, but I always loved playing sports and I was strong. I could run. I was tough. And I had this idea that I had great genetics and I didn't have to take care of my body. And then, at university, I thought, I don't need to run. I'm whatever. I'm naturally good enough. And, I gained like 20, 30 pounds from Bud Light and Papa John's over and over again. Who knew that would add weight and make you out of shape? But even through my 30s, I kind of like worked out haphazardly. And then recently, I've really noticed that, I'm 44 now. You can feel the aging accelerating. You have less energy, less tolerance. It's harder to get out of bed in the morning. You have to pee more often. Your knee starts hurting randomly. And even though I'm in very good shape, I can start to feel my body starting to turn. And so one of the big things that I've set myself up for is on longevity is making sure I sleep 7+ hours every night, working out as often as I can, and giving myself time to recover. I used to burn the midnight oil, work all night, all that kind of stuff, party, wake up at 8 a.m., all that kind of stuff. I don't party anymore. I sleep 7+ hours a night, and I give my body time and space to recover, especially with 3 kids. Like outside of working my kids and working out, I don't do anything because I know my energy level would crash if I did too much. So all these sort of hacks to give me hopefully the longevity to put look at Warren Buffett, like, God, what? I got 50, he's got 50 years on me. So in order to do the long game, you got to take care of yourself.
Well, I don't know, though. He eats McDonald's and drinks Diet Coke every day. So
my hypothesis on him, and this may or may not be true, I don't think he exercises, and I could be off by the number, but apparently your brain uses like 20% of the calories of your body. And so my guess is somebody like Warren Buffett, who never stops talking, never stops thinking. Also, the guy has amazing personal relationships. You can tell he's close to a lot of people and has great friendships. So between like the social connections and using his brain all the time, I think it's a form of exercise. I'm sure it'd be better for him to hit the treadmill and go swimming and stuff like that. But when you're burning all, even if you're drinking Coke, the main downside of Coke is your body can't absorb glucose fast enough, then it gets turned into fat. But if your brain runs off glucose. If you're able to think faster than the sugar in the Coke, you can burn it off. So maybe he's just hyperactive in his brain and it keeps him healthy.
Well, I'm 44 in a few months, and everything you said about the knees and the getting out of bed in the morning resonates with me. And I could probably take a page out of your book on the exercise and health optimization, because definitely starting to feel it. And the stamina side, I got all the respect for what you're trying to do here, because it's an uphill climb and will continue to be. If you secure the bag and do all these things you want to do, it's a lot.
The other important thing is I have an amazing team. You can't do this without other people. And as Scott Galloway says, being outstanding is in the agency of others. And really, you need a great team. The executive team I have couldn't be better. And there's no way that we have this sort of mythology of the CEO founder that, is dull and be all, does all. And that's couldn't be further from the truth. I'm just playing my role in the company, trying to bring everybody together. But really, the team does the hard grinding and the hard yards. And so, I'm standing on the shoulders of everybody else's work. And it's also like, it's not just me like in the coal face grinding. We have a great team, and building a great team is one of those things that you need to build a great company.
Well, man, it's been fun to jam on this, and that sounds like it's an exciting time for the team at Smarkets. So hope the raise goes well, and we'll be following along for the next big launch announcement, I guess.
Thanks very much, and I hope I've demystified the process for everybody.
For sure. Thanks for having me. Bye, Jason.
All right. Cheers, Jesse.
The Business of Betting podcast is presented by Optimove, the #1 CRM marketing solution for the iGaming industry. 4 out of the top 5 U.S. operators personalize player experiences with Optimove, the #1 CRM marketing solution for the iGaming industry. Learn more about Optimove by requesting a demo at optimove.com/businessofbetting. And if you like what you see, you will get your first month free.